Hey, everybody. Thanks for tuning in. We are getting ready to go through the December 2025 Dynamo Capital Fund update. We've got Justin, CEO of Dynamo Capital, here to help us run through that. And just a quick disclaimer, this is not an offering an investment opportunity. This is just informational. If you want more information on that in investing, reach out directly. Get that over here. And then, of course, we still have our data room live and active with tons of information. We'll get this loaded up there as well once this is completed. And as an announcement, VY Dynamo One is still accepting capital. If you are a current investor and would like to increase your position, or if you have been watching and learning as we go and you're ready to jump in, just fill out one of these soft commit forms. That gives us, gets you in the queue, and then it gives us the information on who we need to be contacting to get your questions answered and moving forward. And so, let's see here. All right, without further ado, I'll let Justin jump in here and start sharing how December went.
Yeah, absolutely. So December was a great month for the group. We ended the year on a high note with record volume in originations. Even though the month was a little bit shortened due to all the holiday season. It felt like it was one of the longest holiday seasons I've had in a long time with how the calendar felt. But the team worked really, really hard to ensure that all of our borrowers were able to close by year end. A lot of borrowers wanted to get things done by the end of the year due to depreciation purposes and tax purposes, all that good stuff. So our team worked really, really hard to ensure that we accommodated all of those borrowers. And as has been the theme for most of 2025 and the back half of 2024, still continuing to make a tremendous amount of operational investments in both the systems, the processes, and the human capital, bringing on a lot of great new team members in a variety of different areas to help us feel more considerate in how we are deploying capital, ensuring that we are as safe as we possibly can be with getting capital out the door. So a big focus for 2026 is going to be moving in a direction to increase our sales staff, which will be an interesting endeavor. We haven't necessarily pushed too hard into the sales world. Of the 30 plus people that we have on the team, only 4 of them are in the sales universe. And 3 of them are essentially inside sales that inherited myself and Matthew's book of business to a point. So we really only have one real outside salesperson. So we're going to be making a push in 2026 to grow that team out now that we have the operational capacity and bandwidth to underwrite, service, process the loans in a way that makes us feel comfortable putting more capital through the system. So also a focus for early 2026 is going to be reorganizing our capital markets, which will be mostly surrounding the 2 new lines of credit we're going to be putting in place. So replacing the lines of credit that we have now with 2 new lines of credit that will provide us better economics and better operational efficiency with utilizing those dollars. So great December, really excited about it. In terms of the financials that we were able to put together, we did a little over $1.1 million in revenue. Good chunk of that interest revenue, of course, which we like. Nice, steady, consistent stream of income. Fund expenses pretty trim for the most part. The third-party service providers, legal management, or admin, accounting, all of that good stuff, been pretty steady right around that $30,000 to $40,000 a month mark, with small variances depending on the time of year. Of course, we're going to be coming into Q1. We probably will expect to see our accounting invoices and auditing invoices, of course. So I would expect to see that increase slightly month over month through tax season this year. And our line of credit interest expense, of course, is linear to the amount that we're leveraging, which is helping us increase our portfolio and overall interest revenue that we're collecting. So great month on the fund profit side. We're really pleased with that. We're continuing to see upward trends. So from January to December of 2025, we we've almost increased. It's a little over 100% in terms of profitability on a monthly basis. So trending in a great direction, and we're very confident we're going to be able to continue. Maybe not as aggressive as a trajectory, but we expect to be at a pretty good run rate through Q1 and continuing very similar profitability and month-over-month increases.
Nice. Well, December was the largest month, right? Is that how that?
It was the largest month in origination volume. It was the second highest month in fund revenue. We had a slightly higher revenue in October of 2025. We had a couple of loans that were structured in a way that produced much higher origination fees than we would expect typically. And so there was a little bit of a boost to revenue in October over this, but this was a close second.
Gotcha. Okay. Well, that's a great trend. You want to talk about the origination?
Yeah. So we did just a shade under 20 million in total volume. Average loan amount of 832,000 on 23 loans, dispersed throughout the Midwest and mountain regions, mostly concentrated in Wichita, of course, which is home base, and then the Denver MSA, which we've been very active in over the last 3 or 4 months. So still seeing great performance out in that market. I'm not sure if the audience is mostly Denver folk here, but I would tend to assume mostly is. We're not loaded on condos in downtown Denver. I promise. We're being very, very conservative on the areas we're lending in with borrowers that have a very proven track record. So you'll see, if we look at our loan tape, the vast majority of the volume we're doing in the Denver MSA is in the Boulder area and in the higher priced areas that are still moving quite effectively and are still producing good BRRRR results. So those are the markets that we're targeting and the borrowers that have like I said, a proven track record of performance in those markets. So everything thus far has been performing very, very well. We've had two of those loans pay off already within early. So that's what we want to see. We're trending in a good direction there, and it gave us a lot of confidence deploying capital into that market because it's the first mature market, new market other than the home base that we've really lent in at a high level. And Caitlin, our local loan officer, obviously has very deep relationships, and she's local to Denver, and she's been a great advocate for us out there, and also a good first line of defense. She's the first person to turn away deals that she knows we're not going to like, and she really treats our dollars like it's her dollars, and that's exactly what we want out of our sales staff. So. Going back to what I was saying earlier, the hardest part about growing into new markets and growing our sales organization is finding more people like Caitlin who really treat our dollars like their dollars. That's the hardest part. A lot of salespeople are there to make a commission and move on, and so there's an alignment of interest that we need to ensure is there, and we're very, very cognizant about that and focused on ensuring that we find the right people with the right compensation plan that incentivizes everybody in the same direction.
Gotcha. Now, you mentioned you were looking at hiring more salespeople. Or is that going to be in Wichita and Denver, or is that going to be expanding geographies?
It'll be in new markets. Yep. So we, in terms of our geographic growth strategy, we have to take it 2 different directions. So our target is to be, to continue to be a premier lender throughout the Midwest. So we'll be following the I-35 corridor. So Kansas City, Oklahoma City, Nebraska, Des Moines, Wisconsin, Minnesota, a lot of these markets, mostly untapped for the most part. A lot of mom and pop places. And so our growth strategy in those markets is going to be much more organic. It's going to be much more farming a loan officer in that market, finding somebody with good relational skills who is wanting to make some sort of change. But that's going to be a bit of a slower roll, right? It's going to be, rolling a snowball up the hill. Eventually it'll get big enough that it'll start rolling by itself, but there's gonna be a bigger lift there. But also there's some key markets throughout the country that we're excited about, that we think either are on an upswing or have hit maybe a little bit, have hit close to the bottom of where that market is, and it's going to be primed for an upswing. over the next, call it 7 to 10 years. And so we're also looking at, typically those are more mature markets, Denver being one of those, more mature markets in the private lending space. So our strategy in those markets is find good existing loan officers that want to work for a lender that does common sense underwriting and understands the needs of the borrower and is focused on the relationship with their borrowers, and essentially buying the production, right? People with an existing book and loan officers that know what they're doing, and giving them a better platform to be able to operate within. So those markets are, Texas markets, right? Dallas, San Antonio, Nashville, Salt Lake City, some of these markets that we see some influx of capital moving in, but not a tremendous amount of private lending activity, or enough private lending activity that gets us excited. But we feel that there's a space for us to still slip into that market.
Oh, perfect. All right. Well, that's super helpful. Let me see what we have next. Talk a little bit about loan to value.
Yeah. So nothing too crazy here. You'll see a declining trend over the last, call it 6-7 months. Our portfolio average LTV has been falling. And I think this really goes back to the quality of the assets that our team is finding. We're seeing a lot more, and as we're deploying more capital into the Denver market, we're seeing an average LTV fall as well, because we're just a little bit more conservative in that market as well. We want to be able to absorb market changes, and we just want to be more conservative. So we've started to see that trend go down naturally. We haven't made a very tremendously hard push to lower the LTV for one reason or another. It hasn't correlated with better or worse performance in the portfolio as of this point in time. But we like knowing that even if the market takes a dump tomorrow, that we have 35% room before we have any sort of reason to think that principal may be at play. And even then, it makes an assumption that the borrower stops making their payments. And real estate investors are quite savvy, and so they're very apt to not lose money, and they'll do just about everything they can to ensure they don't. So that works out in our favor too, as we work with those borrowers to make sure that everybody's protected.
Perfect. And that is a great question. Is is there any? I know our investors are new to this space, and debt funds in general. Some of them are familiar, some have no familiarity with them. As far as the potential to lose any capital.
Yeah. Obviously we cannot guarantee anything, right? We may get a nuke dropped on us tomorrow, and something crazy could happen like that, obviously. But we take a tremendous amount of pride, and we focus very, very heavily on ensuring that we are protecting fund capital. That is the absolute first thing that every employee in this company understands about what we do here is we protect capital. Even if that means we stop funding loans for whatever reason, because we're concerned that the market is not performing at the level that we would expect, or we have reasons to believe that the market's going to move in a direction that's adverse to performance in our portfolio. We have no obligation to lend, right? Now, that's our business, and that's what we do, and that's how we generate yield, of course. But the first thing that we're always concerned about is ensuring that we understand our risks, and we mitigate the risks when lending as much as humanly possible. And a couple of the ways that we do that is by having conservative loan to values, right, to be able to absorb market changes. It's by building a big balance sheet. We're not reliant on capital partners outside of our walls to buy our loans or to provide us liquidity, right? We utilize lines of credit, and we utilize leverage, but we utilize it as a liquidity tool. We don't utilize it because we have to. And it gives us the comfortability to know that even if the entirety of the stock market takes a dump, that we're not going to necessarily be affected, right? Now, our yield's going to go down, sure. Or is the income that we're generating going to go down? Yes, of course. But we're very, very confident that we can absorb those types of black swan events and not be in a position where we're losing principal to our LPs. So we're very, very cognizant of that, and that's always going to continue to be the main focus.
Perfect. That's good to hear. I know I've heard that from you before, but I just want to make sure that our investors know that that is a primary focus for you guys. I guess looking ahead, 2026, you kind of touched on it earlier, but
yeah, we did touch on it a little bit earlier, but as we mentioned, a big goal for us is going to be to really press 2026 hard on the sales front. We've got the processing team in place, we've got the underwriting team in place. We're building the servicing team out to support the additional loan portfolio that we're building. And so a big focus for us is going to be bringing on sales leaders to help build out the sales organization and continue to expand our geographic presence both throughout the Midwest, the mountain regions, and then moving east. For anybody asking, we're probably not going to be lending in California or the West Coast anytime soon. We don't know the market. We don't like it. It's too competitive, and we don't understand it very well. So we like, we know what we know, and we're going to continue lending in the markets that we understand. And we're happy to continue also splashing in the shallow end of the pool and doing the loans that people are overlooking because those borrowers still need served. There's still transaction activity that's happening. And we're happy to continue serving those customers throughout 2026.
Great. All right. Well, I think this next slide is me. This is for our VY Dynamo 1 investors, working off the 50-50 split at a 1.94 fund return. And your Class A return was 1.55%. Actual year-to-date return on actual financials, had your money been invested all of 2025, would have been 17.04. And for Class B investors, that would be 1.75% and 19.919%. So amazing yield, right at kind of on target with what we have been forecasting, which is pretty amazing. It's pretty impressive that you're so close to target, even slightly ahead. So pretty exciting. I know that I'm excited as an investor to be part of it. So I hope that this information gives you guys some comfort and where your money's doing and going to be put to work, and a little bit of diversification in your portfolio, which is kind of the goal.
That's the goal.
All right. Well, thanks for your time, Justin. I won't keep you any longer. I want to get this out to everybody to take a look, and have a great weekend.
My pleasure. You as well.
Next month.
All right. We'll talk soon.
All right. Thanks. Have a good one.